Good morning, welcome to IG's Early Morning Call. It's Wednesday, the 10th of January. Let's take a look at the headlines. As the Nikkei 225 rises to a 34-year high, it's one of the high points in what is otherwise a market that's looking down at the start of today's European session. Most of Wall Street down yesterday, apart from tech stocks, that is, which were the outstanding performance on the upside. But the Nikkei is stealing all the headlines this morning on those equity markets. In terms of economic and corporate data out today, the UK retail sector is very much in evidence this morning. We've got updates coming through from Greggs, from Sainsbury. We've also got an update as well coming through on the consumer's ability or inability to be able to afford homes, coming through from Persimmon this morning. Christmas trading statements beginning to develop across the way, and the supermarkets looking like they could well be the winners. And Hewlett-Packard Enterprise late last night confirming what the market was expecting over the prior 24 hours, that is to buy Juniper Networks in a further move into artificial intelligence for HPE. It's a $14 billion deal. It's a 30% premium. It's $40 a share for Juniper Networks by HPE. Let's take a look at volatility, down again today. And in fact, this little symmetrical triangle has now come to fruition. We've got a breakdown below the rising line of support back end of last week. We've got 3 more days of declines. We're now sitting at levels in terms of volatility not seen since the 15th of December. And interesting enough, the markets don't look like they are benefiting. Normally when you get a drop in volatility, you get a rise in risk assets. It's certainly not what's happening here in London. If we get a close today on the markets at 76.59, which is where we are, it'll be the lowest close we've seen since the 20th of December. This blue box, of course, remembering, was the gain that we saw last year, 3.2%. Mostly the continental markets have been slightly better off than the London markets. Not necessarily. Second day in a row of losses at the moment for the German DAX. This time yesterday, we were looking at gains at the start of yesterday's trade, but that turned into a negative swing after the positivity we saw on Monday. So markets back to a negative. And really what the message is, I think, here is, same for the French markets, you can see at the moment, the message is here that the markets are, or traders, are now beginning to price in somewhat more robust inflation coming through from the US tomorrow, which could well indicate that the Fed is likely to keep interest rates on hold at March, not cut. I'll go into some more detail about that. This is the French CAC 40. If we close at these levels, it'll be the lowest close we've seen there since the 6th of December. So you can see the broad message is here today that we've got these markets with a little bit of frailty coming through for the start of today's session. Overnight in the Asia Pacific markets, there's no doubt about it that the Japanese markets absolutely the really big runaway winner today. Outside of that, we got losses. The Nifty 50 down, the Hang Seng down, the S&P ASX down. The Singapore Straits Times also on the way down in the session today. So what's giving this boost? Let's take a look at the Nikkei in terms of the chart. Absolute runaway today and beating this high that we saw back in June last year. 24-hour markets continuing to trade. We're up at 34,513. 34-year highs, Nikkei 225. I think one of the factors in this is this weaker Japanese yen. The yen pushing lower today. This is the dollar rising against the Japanese yen. When you get a weaker Japanese yen, quite often you get money going into the equity markets because those exporters enjoy the benefits of a Japanese yen. It's easy to sell into overseas markets. And when you do sell, you get a better rate of return for your dollars or your pounds or your Canadian dollars, whatever it is, against that weaker Japanese yen. So it's a double positive whammy for these companies, which is why I think part of the reason why we're seeing people buying into the Nikkei. But of course, that 34-year high, remembering all the way back in 1989, whenever it was, when we saw the Nikkei up at the 39,000 level, we're still far short of that. But this weaker Japanese yen giving a little bit of an uplift to that market. Where it goes from here, let me just quickly return to the Japanese markets. When you get these new highs, it's quite often very difficult to work out where the next line of resistance is, but 39,000. I've got it on here, 38,950 was the record high that we saw back in 1989, I think it was. We're still quite some distance for that, but it just goes to show the problems that the Japanese economy has had over the last few decades or so with deflation, with concerns about the general move in the markets. Now, let me just take a look in some more detail about what's been happening on Wall Street, because as I said at the top, it's a day when we saw money going into techs, but not into the other markets. You can see the S&P 500 down, Dow Industrials down. Yes, we got a gain for the Nasdaq, but it was only a tiny gain in the grand scheme of things. But it nonetheless was one of the outstanding performers. Let's take a look at the Nasdaq 100 on the IG platform today. We're opening on the 24-hour markets, pushing a little bit higher still, 16,678. What I'm going to do is let me take this Fibonacci off now here so we can get rid of that. Broadly speaking, this retracement that we saw here from the start of the new year has really sort of come back again now, and we've got money going back into it. It is the big stocks that are benefiting most again, the Apples, the Microsofts, the companies that are performing well in the AI environment. And that's what's really boosting these markets. Outside of that, old tech stocks, the Dow, this is the record high that we saw, what was an intraday record high back on the 2nd of January, when this market went up to 37,815. And we're not too far away from that, and the market's still looking as though they want to move higher at some point. It's just a question of the excuse. And I guess we're all waiting for tomorrow's CPI data out from the States. Talking about CPI data, overnight we've seen some numbers coming through from the Australian economy on the CPI monthly indicator, rising by a margin of 4.3% in November, year on year, down from 4.9% in October, and less than the market forecast of 4.4%. It's the second straight month of moderation in annual inflation, which is what the Australian Central Bank really wanted to see, and that's exactly what they got. Looking at what's happening on the Aussie dollar in this second straight month of moderation, this latest reading is the lowest reading since January 2022, I should say. The Aussie is up today at 66.98, but broadly speaking, holding on to the losses that we've seen recently against that stronger US dollar. Talking about the US dollar, later on this afternoon in the States, we get some economic data out. It's not major premiership data. It's a little bit lower on down than that. Wholesale inventories forecast to fall 0.2% in November month on month. It'll be interesting to see why that's happening. Normally when you get a drop in wholesale inventories, it means that we're working into some of the backlog. It's not a massive fall, but we'll have to see how that data comes out later on today. For all this, I'm taking a look at what's happening with the dollar basket. Now, I said in my note to clients this morning, if you don't get it and you do want to get it, have a chat with your client manager. I send these out first thing in the morning, and I was just talking about this rise for the dollar. It's not a stunning rise, but it is outside this channel that we've been in. A relatively strong candle yesterday, closing up above the top side of the channel, so we're now officially out of it. And today's session, we've got an entire candle above that at 102.16. So money is going into the US dollar. And ahead of the data out today, albeit some minor data, wholesale inventories, we've got euro dollar trading at 109.38. Price target, if you are watching this on the way down, remains at 108.83, although this area of support here is an interesting area between the 108.22 and 108.83. If you're looking at that at the moment, at least in the last few days, it has used that as support. We'll have to see how things develop. But as I said, it's really, I think, all about what's happening with the economic data out tomorrow for US CPI. Let's take a look at some of the corporates to watch out for. One of the headlines this morning we've been talking about has been Sainsbury's third quarter trading statement. Sainsbury's comes into sort of two categories. We've seen this from Marks and Spencer's before. We get food on one side, general merchandise on the other. And if you look at some of the news headlines that we're getting out from Sainsbury's this morning, it is absolutely that. There's a big demarcation between what has been an excellent Christmas period for grocery volumes, growth driven around market performance. More customers are doing more of their grocery shopping at Sainsbury's, according to this update this morning. The company says we've outperformed the market every week of this financial year and delivered volume growth ahead of the market for a fourth consecutive Christmas. Look at the numbers. Q3 grocery sales up 9.3%. Grocery sales for Christmas particularly up 8.6%. But conversely on that, general merchandise, clothing especially, down 1.7%. Christmas clothing sales down 6%. How many Christmas jumpers do you need? In a time of constraint, consumers are not going to go out and buy things like Christmas clothing. So that, no real surprise, down 6%. Nonetheless, because of that big rise in what is the big part of the business, the grocery sales, the company's been able to maintain its profit outlook. The company says it reflects consistently great value and service, a positive customer response to our first Nectar price Christmas and Christmas trading up to taste the difference. Broadly speaking, this is an opportunity for the company this morning to wave a flag on what it's doing, and it's basically a company which is doing all the right things. And you can see this actually in the trading price action we've seen yesterday, or the last couple of days. We've seen it trade at levels not seen since the back end of August 2021. Really big gains recently in anticipation of this number. And in fact, on Monday, we saw it peak up above the 310 level. And I suspect we could well get up there again today. Closing down yesterday along with the general market move, 306.05. 306.5. Marubozu candle yesterday, no buyers at the bottom of yesterday's candle at the close of the session yesterday. If you're long on this, I'd put my stop below the 300 level, the £3 level, with a view to taking it up. And I wouldn't be surprised if we saw new highs. That being said, the company is not actually changing its outlook for profit of between 670 and 700 million for the full year, with strong grocery performance offsetting weaker general merchandise and financial services contributions. The company is maintaining its profit outlook before tax. So that's where we are in terms of the moves there for Sainsbury's. Let's move on to Greggs, the high street baker, not known for its Christmas offering necessarily, but the company is nonetheless doing well. Full year total sales up 19% to 1.8 billion. Expectations have been for somewhat lower figure than that. Full year like-for-like sales up 13.7%, up 9.4% in the fourth quarter. And the company continuing to benefit from increased footfall as people do come back into the office. It's not a massive move, but you'll see in the papers about the way in which a lot of employers are now wanting people to come back into the office. Look at what happened in terms of trading. We've seen that stock trading cap out at £26.42 recently. Yesterday it closed down at £24.70. In the grand scheme of things, you can see the way we're travelling at the moment. But I think broadly speaking, this is a good positive update. How much of yesterday's market was a general market move down? I suspect quite a bit. So I think if there's anything to do here today, there's a potential that we could well see upside. A record 220 new shops opened in the year with 33 closures, 42 relocations. The company does what it does best, and that is it's very flexible on its attitude to where it has shops. You can literally pick up a shop and turn it around the corner really quickly. Same staff, same boarding, same everything, that it just moves with it. It's almost like a pop-up shop. It's very, very adept at doing that. And Rasheen Curry talks about the way in which the company continues to adapt to footfall and to what it believes to be the best place for its shopping. Good progress in development of supply chain capacity. Interestingly, she also says inflationary pressures reducing. So potentially there is upside trade to go here from 27.40. Stock goes below some of the recent price action. Let's say you stop at around about the £24 level, with a view to taking it back up, possibly in the direction of the 26.42 for Greggs. The company anticipates full year outcome in line with previous expectations. Not so for Persimmon. Persimmon, the house builder, has said a very different list of things that the company is facing. Housing market conditions remain tough in 2024, according to Persimmon. Highly uncertain market conditions, especially for first-time buyers, as elections loom, particularly not just for the country as a whole, but here in London as well. With Sadiq Khan and his team hoping for another term. And with those elections comes uncertainty, according to Persimmon. Let's take a look at the share price chart, which has recently broken to new recent highs. Yesterday, it closed down below this line of resistance that we'd had on here from the highs that we had intraday back on the 2nd of May. That close that we saw on Monday was the highest close we've seen in this business since the 1st of March 2023. Yesterday, a drop down in the market, and I suspect we could well see a continuation of this today with the housing market conditions to remain tough. The company has seen new home completions for last year down a whopping 33%. Average selling price is up 3%, but the company hasn't been putting as many houses through the pipe because of concerns about the rise in inflation. Operating margins expected to remain at those that were delivered in the first half at 14%, reflecting the impact of build cost inflation coupled with the effects of lower volumes. The outlook, not quite so sure about 2024. The company, in its statement, says we entered 2024 with private forward sales ahead of last year, driven by the year-on-year improvement in fourth quarter sales rates. But if you dig down deeper, it says that housing market conditions will remain tough in 2024, expecting a drop potentially for Persimmon at the start of today's trade. I would just say that it's not a trading recommendation. It is just a suggestion based on the RNS that's in front of me this morning, for which I've had half an hour to digest the contents. Let's take a look at another company worth looking at. It's been confirmed after a day of speculation that HPE, Hewlett-Packard Enterprises, has now bought, and it's confirmed a full acceptance of the offer at $40 a share for Juniper Networks in an all-cash deal valuing the business at $14 billion. Let's take a look at the details that we've seen. It represents a 32.4% premium to the stock's close on Monday when the news first emerged as speculation. With this acquisition, HPE says it wants to boost its AI-driven offerings, particularly in network security and enterprise networking operations. Now, as one might expect, in yesterday's session ahead of the news, we saw a really big rise in the stock of Juniper. Look at this all the way up here, massive, great big gap. But as I said, it was just really speculation at the time that this was going to happen. But it is way short of the $40 level, which is this red line up here. The last time we saw $40 was back on the 3rd of May 2011. Well before the point at which we saw any speculation about artificial intelligence. So HPE buying this at $40, a 30% premium to the close that we saw back on the 8th of January when the stock was at $30 a share. $40 is the agreed price, and Hewlett-Packard, I guess, when things get underway later on today, neither of these are all sessions. I suspect we could well see this pull on further on down for this level down here. 14.92 is the next line of support. There is another one just a little bit up from where we are at around about the $15 level. We could well see declines at the start of today's trade for HPE. Let's move on to take a look at other areas of the market. I want to bring up a chart for US crude to take a look at what's been happening with oil prices. This descending line of resistance continues to hold, broadly speaking. The move there we've got a second day in a row of gains, actually, but we're still within the confines of this falling line of resistance. According to the API yesterday, crude oil inventories fell yesterday, decreased sharply for a second week in a row. Last week, crude oil stocks fell by 5.2 million barrels. Gasoline inventories rose, as indeed did distillates for the last week. So that takes into account a recovery in the price of oil on from the big declines we saw there on Monday. Let's return to the charts and go back onto gold, flatlining for a second day at 2031. And while we're on the charts, just wanted to return to something I was talking last week to clients about. And we were having a discussion about what's going on with this chart here. This is copper. Now, there is an Elliott wave. Now, I was criticized for this last week because technically speaking, this 3 to 4 level here negates the Elliott wave because it fell below the high point we had back on the first part of the wave. Elliott wave is I've never considered it as particularly precise, but technically speaking, the fourth wave can't drop below the first wave peak, and technically speaking, it did. So really, it has negated this Elliott wave. That being said, it continues to perform here, and I'm wondering whether perhaps maybe if you do bend the rules a little bit, there is potentially here a 3-wave correction. The corrective waves come down from the peak in a 3-wave, and ultimately what then happens is that you then get the runaway win wherever that goes. but that is big speculation at the moment. We are, as of yesterday's close, down at the drop. If you get a drop below the fourth, I mean, it just completely it negates anything that we've got. But at the moment, at least, if you do bend the rules a little bit, we've still got this elliott wave in play. But we'll have to see how things develop. If we do get a little bit of a rally on up to wherever this next line comes to, we're then still within the confines loosely of the elliott wave, corrective wave system that we've got. A little bit difficult, I guess, to certainly qualify it's going to happen, but we'll have to see how things develop on the price of copper. Now, the recent rally in Bitcoin received a temporary boost late on Tuesday, and the crypto briefly rose to within a short distance of 48,000 on what transpired was actually fake news. A social media post announced the SEC had approved ETFs for Bitcoin. Let's take a look at the chart of Bitcoin as it raced away yesterday, up 209% from the low point. That social media post announced the SEC had approved ETFs for Bitcoin. The message was sent to the SEC X account or Twitter account. Within minutes, the SEC had deleted and disowned the information and said that as of Tuesday, it had not approved the BlackRock ETF application. Now, since that fake news, we now know it as, was pulled out from the market, we have seen a drop. We saw a drop yesterday, ultimately, in what was a positive day to begin with. And today we picked up on the downside. It is not too far away. The SEC has not said it will not approve the BlackRock ETF, but it's just a question of when and in what capacity this will be approved. But yesterday we saw highs in Bitcoin that we've not seen in this market since March 2022 on fake news. That's it. We're back at 10:30 with Charting the Markets. Do watch out for those stocks at the start of the day's trade here in the UK as we continue to monitor what's going on in the fourth quarter and back end of last year. Persimmon doesn't look particularly good this morning. Greg's a little bit of a doubt about the direction of travel, possibly up. But Sainsbury is certainly looking as though it could well see a little bit of a gain at the start of the day's trade on what was good grocery business over the Christmas period for the business. We're back at 10:30 with Charting the Markets.